The most seductive lie in the world of finance, the one whispered on trading floors and shouted on financial news networks, is that the secret to wealth is knowing when to sell. It's a siren song of market timing, of calling the top, of getting out right before the crash. It frames the investor as a seer, a prophet who can predict the chaotic whims of millions of people. But this is a fantasy, and it is a fantasy that has cost aspiring investors more money than any market crash in history. The real secret, the foundational truth upon which fortunes are built, is far less glamorous, yet infinitely more powerful. It's a principle so simple, it feels almost insulting, yet so profound it has guided the single greatest investor of our time, Warren Buffett, for over 70 years. The principle is this: you don't make your money when you sell. You make your money the moment you buy. The price you pay is not just one of the factors determining your return, it is the single most dominant, most critical, most inescapable determinant of your financial destiny. Everything else is secondary. The entire game of investing, of building wealth, of achieving financial freedom, is won or lost at the point of purchase. Chasing a hot stock as it rockets upward, convincing yourself that valuation no longer matters because this time it's different, is not an investment strategy. It is a ticket to a public execution of your capital. It is the path of the 99%, a path littered with broken portfolios and shattered dreams. But there is another way. By internalizing this one single principle, you can undergo a complete financial transformation. You will cease to be a speculator, a gambler tossed about by the waves of market sentiment. You will become a disciplined, price-conscious investor, a business owner who patiently, deliberately waits for the irrationality of others to present you with a golden opportunity. You will learn to buy assets at a discount to their true worth, locking in your potential for extraordinary returns and building a fortress around your capital from the very first day. This isn't about a clever trick or a secret algorithm. It is about a fundamental shift in perspective. It is about understanding that a wonderful company bought at a terrible price becomes a terrible investment. The true secret to long-term portfolio growth is the discipline to wait for the market to offer you a wonderful company at a fair or even a wonderful price. This is how you stack the odds in your favor. This is how you build a margin of safety that protects you from your own mistakes in the market's madness. This is the foundational law of value investing. The final promise that profit is not a hope, but a guarantee you make to yourself on the day you buy. The entire architecture of Warren Buffett's unprecedented success rests on a single, unshakable foundation. It's a concept he learned at the feet of his mentor Benjamin Graham, the father of value investing, and it has served as his North Star through every market boom and bust for more than half a century. This concept is the margin of safety. It is the bedrock, the core principle from which all other strategies flow. In its simplest form, the margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. It is buying $1 for 50 cents. It's not just about getting a good deal. It is the ultimate form of risk management. It is the buffer that protects an investor from bad luck, from errors in judgment, and from the wild, unpredictable swings of the economy. It is the only true guarantee in the uncertain world of finance. To truly grasp the immense power of this idea, we must travel back in time to 1963, to a moment of crisis that threatened to bring down one of America's most trusted financial institutions, a crisis that came from the most unlikely of sources: salad oil. The story begins with a man named Anthony Tino DeAngelis, a charismatic and cunning commodities trader in Bayonne, New Jersey. His company, Allied Crude Vegetable Oil, was a major player in the vegetable oil market, a key export under a federal Food for Peace program. DeAngelis had a simple but audacious scheme. He borrowed massive amounts of money, using his vast inventory of salad oil as collateral. The problem was, the inventory was a ghost. His giant storage tanks, supposedly filled to the brim with millions of pounds of valuable oil, were mostly filled with water, with only a thin layer of oil floating on top to fool the inspectors. For years, the fraud worked. Lenders, including subsidiaries of some of Wall Street's most respected firms, extended him more and more credit. One of his biggest creditors was American Express, not through its iconic credit card or traveler's check business, but through a warehousing subsidiary that certified DeAngelis's phantom inventory. In November 1963, the house of cards collapsed. DeAngelis defaulted, the fraud was exposed, and the market was thrown into a state of absolute panic. The news hit American Express like a freight train. Wall Street analysts, caught completely off guard, scrambled to calculate the company's liability. The fraudulent warehouse receipts totaled an astonishing $175 million, a sum that was larger than the entire net worth of American Express at the time. The narrative on the street was simple and terrifying. American Express was insolvent. The stock, a blue-chip darling, began to hemorrhage value. It plummeted by nearly 50%, wiping out hundreds of millions of dollars in market capitalization in a matter of weeks. Fear was palpable. The herd was thundering for the exits. This was not a time for sober analysis. It was a time for survival. And in Omaha, Nebraska, a young Warren Buffett watched the chaos unfold. He wasn't panicking. He was intrigued. While the rest of the financial world was asking, "How big is the liability?" Buffett was asking a different set of questions. Is the core business of American Express affected by this? Do people still trust their travelers' checks? Are restaurants still accepting their credit cards? He refused to get caught up in the headline fear. Instead, he began his own unique brand of research, what his partner Charlie Munger would later call the scuttlebutt method. He didn't just read analyst reports. He went to the source. He walked into restaurants and travel agencies around Omaha. He talked to the cashiers, the managers, the people on the front lines. He asked them if they were still accepting American Express cards and traveler's checks. The answer was a resounding yes. He went to local banks and asked if they had seen any decline in the use of Amex products. They hadn't. He observed customers with his own eyes. They weren't throwing their green cards in the trash. They were using them just as they had the week before. What Buffett discovered was that the salad oil scandal, while a huge and embarrassing financial hit for one subsidiary, had absolutely zero impact on the powerful, global brand and the core operating businesses of American Express. The company's competitive moat was its reputation with consumers, and that reputation was pristine. The market, in its panic, had conflated a contained one-time loss in a peripheral division with the complete destruction of the entire enterprise. After doing his homework, Buffett calculated that the company's intrinsic value, based on the earning power of its primary businesses, was far, far greater than the market price, even if they had to pay out every single dollar of the salad oil liability. The market was selling the entire company for roughly $150 million, while Buffett believed the core business alone was worth multiples of that. The gap between the price and the value was enormous. It was a cavernous margin of safety. Convinced by his on-the-ground research, Buffett made one of the boldest moves of his early career. He invested $13 million, a staggering 40% of his investment partnership's entire capital, into American Express stock. He wasn't just buying a stock. He was buying $1 of pristine, long-term earning power for what he calculated to be less than 40 cents, with the market throwing in the brand for free. Over the next 2 years, as the company settled its liabilities for a fraction of the feared amount, and the market realized the core business was a money-gushing machine, the stock roared back. Buffett's partnerships more than doubled their money. That single, courageous decision, rooted entirely in the principle of margin of safety, cemented his reputation and laid the financial groundwork for the creation of Berkshire Hathaway. The American Express salad oil scandal is a masterclass in the behavioral science that underpins all great value investing opportunities. The market's reaction wasn't driven by rational calculation. It was a textbook case of two powerful cognitive biases working in tandem: loss aversion and fear contagion. Understanding these psychological forces is critical, because they are the very engines that create the discounts, the margins of safety that a disciplined investor can exploit. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes a fundamental asymmetry in the human brain. We feel the pain of a loss approximately twice as powerfully as we feel the pleasure of an equivalent gain. Losing $100 hurts far more than finding $100 feels good. This is an evolutionary defense mechanism. For our ancestors on the savannah, losing a food source could mean death, while finding an extra one was merely a bonus. In financial markets, this deep-seated bias has devastating consequences. When a stock like American Express was hit with the shocking news of the scandal, investors didn't just see a potential financial loss, they felt an intense, visceral threat. The brain's amygdala, its fear center, goes into overdrive. The potential for loss, especially total loss or insolvency, triggers a primal flight response. Rational, long-term thinking, which occurs in the prefrontal cortex, gets completely short-circuited. Investors weren't thinking about the discounted value of future cash flows from the traveler's check division. They were reacting to the terrifying headline, "Liabilities exceed net worth." This intense fear of loss caused them to sell indiscriminately, at any price, just to make the pain and the uncertainty stop. This leads directly to the second psychological principle, fear contagion, a close cousin of herd behavior. Humans are social creatures. We look to others for cues on how to behave, especially in situations of uncertainty. When we see everyone else running for the fire exit, our instinct is not to stop and analyze the architectural plans to see if the fire is contained. Our instinct is to run with them. In 1963, the herd was Wall Street. The analysts, the brokers, the fund managers, they were all running. The story they told each other was simple, powerful, and terrifying. Amex is going to zero. This narrative spread like a virus. An investor holding the stock would see it plummeting, hear the panicked commentary on the news, get a call from their frantic broker, and conclude, "Everyone else is selling, they must know something I don't." The pressure to conform, to join the stampede, becomes immense. It feels safer to be wrong with the crowd than to be right all alone. Warren Buffett's genius was not in complex financial modeling. It was in his ability to immunize himself from this psychological pandemic. His brain operated on a different frequency. Where others felt the gut punch of loss aversion, he saw a statistical probability. He acknowledged the potential loss from the scandal but framed it as a quantifiable variable in a larger equation, not as an existential threat. He effectively told his amygdala to sit down and be quiet while his prefrontal cortex went to work. More importantly, he completely rejected the signals from the herd. His scuttlebutt investigation was a deliberate act of cognitive independence. By talking to merchants and bankers, he was gathering his own proprietary dataset, one that was completely divorced from the contaminated dataset of Wall Street's sentiment. He was building a rational case based on facts on the ground, while the rest of the market was reacting to a ghost story being told around a campfire. He saw that the fear was about a single, isolated event in a subsidiary, but the contagion had infected the valuation of the entire healthy parent company. This disconnect is the very definition of a margin of safety. It's an arbitrage opportunity, not on price but on emotion. Buffett was buying a superlative business, not just at a financial discount, but at an emotional discount. The price was low because the fear was high. The margin of safety he received was a direct payment for his willingness to be rational when everyone else was terrified. This is a pattern that repeats in every market cycle. A crisis hits, a financial crash, a pandemic, a shocking scandal, and the dual forces of loss aversion and fear contagion take hold, creating absurd pricing for wonderful assets. The disciplined investor understands that their job is not to predict the crisis, but to be psychologically and financially prepared to act when the inevitable panic creates the opportunity. The abstract concept of a margin of safety is useless without a practical, repeatable process to identify and act upon it. We can translate Buffett's actions during the salad oil scandal into a concrete mental model, a blueprint that any investor can apply. Let's call it the ground truth investigation framework. It's a method for cutting through market noise and building a conviction based on reality, not on headlines. The first step is to become a crisis connoisseur. You must actively hunt for companies that are being punished by the market. This means creating a watch list not of the hottest, fastest-growing stocks, but of established, high-quality businesses that you already understand. These are your wonderful companies. Then you set up news alerts specifically for these companies, but you're not looking for good news. You are waiting for the bad news. You are waiting for a product recall, an accounting scare, a lost lawsuit, a failed acquisition, an event that triggers a sharp, sudden drop in the stock price. This is your signal to begin, not to panic. The second step is to immediately quantify the absolute worst-case scenario. This requires putting on your most pessimistic, cynical hat. Read the negative reports, and for the sake of the exercise, assume they are 100% true. If it's a lawsuit, assume the company loses and has to pay the maximum possible damages. If it's an accounting issue, assume the financial hole is as deep as the critics claim. Your goal is to put a hard, dollar number on the maximum possible damage from this specific event. For Buffett and Amex, this was the full $175 million in liabilities. This number becomes your contingent loss. It is crucial to isolate the damage to the specific event and not let the fear bleed into your assessment of the entire enterprise. The third step is the most critical, the scuttlebutt or ground truth investigation. This is where you leave the world of spreadsheets and stock charts and enter the real world. Your mission is to determine if the crisis, the source of the market's fear, has actually infected the company's core business and its relationship with its customers. This process will vary depending on the business. If it's a retail company like Starbucks, you go to several stores at different times of day. Are they busy? Are people still happily buying their coffee? Talk to the baristas. Is morale good? If it's a software company like Microsoft, you talk to IT professionals who use their products. Are they planning to switch to a competitor because of the bad news? Is the product still essential to their daily operations? For American Express, Buffett talked to the merchants and bankers. The goal is to find evidence that contradicts the market's panicked narrative. You are looking for signs of resilience in the core business, proof that the company's competitive moat is intact. The fourth step is the calculation. You take your estimate of the company's intrinsic value before times the crisis. This is your baseline. Then, you subtract the contingent loss you calculated in step 2. This gives you a new, post-crisis, worst-case intrinsic value. For example, if you believed a company was worth $10 billion and the maximum possible damage from a scandal was $1 billion, your new worst-case value is $9 billion. Now you compare this number to the company's current market capitalization. If the market, in its panic, has pushed the stock price down to where the entire company is valued at, say, $4 or $5 billion, you have found a massive margin of safety. The market is pricing in the apocalypse, while your ground truth investigation and conservative calculations show that even in the worst possible outcome, the business is worth at least double the current price. This gap is your protection. It's your reward for doing the hard work of independent thought. It ensures that even if your calculations are a bit off, even if things turn out a little worse than you expected, you still have a high probability of not losing money and a significant chance of making a very handsome return. This blueprint transforms investing from a passive act of clicking a buy button based on a TV pundit's opinion into an active investigative process. It gives you an information advantage not based on insider tips, but on simple, publicly available observation that the panicked herd is too scared to undertake. To fully appreciate the wisdom of Buffett's approach, we must shine a harsh light on its opposite, the antithesis, the path walked by the 99% of investors who consistently underperform. This path is called buying the narrative. It is the siren song of a good story, the belief that a compelling concept can trump the cold, hard reality of financial valuation. It is the single greatest destroyer of capital for the retail investor. The narrative investor doesn't start with a balance sheet, they start with a story. It might be the story of a visionary CEO who is going to change the world. It might be the story of a disruptive new technology that will render all old industries obsolete. It might be the story of a new paradigm where traditional metrics of profitability and cash flow no longer apply. The story is exciting, it's easy to understand, and it's even easier to repeat to your friends at a dinner party. The dot-com bubble of the late 1990s was the golden age of narrative investing. The story was, the internet changes everything. Companies with names like Pets.com, Webvan, and eToys.com came to market with no profits, often with no clear path to ever making a profit, but they had a powerful narrative. They were going to revolutionize how people bought pet supplies, groceries, and toys. Investors, swept up in the euphoria, abandoned all traditional valuation. They weren't buying a share of a business's future earnings. They were buying a lottery ticket on a story. The price they paid became completely detached from any underlying economic reality. When a skeptical analyst would point out that a company like GeoCities, a web hosting service, was valued at billions of dollars despite having negligible revenue and massive losses, the narrative investors would reply with the four most dangerous words in finance. This time it's different. They argued that metrics like eyeballs and user growth were the new valuation tools, and that profits were an old-fashioned concern. They bought the narrative, and as more people bought, the stock prices went up, which in turn seemed to validate the narrative, creating a self-reinforcing feedback loop of speculative mania. Compare this to Buffett's approach with American Express. The narrative investor in 1963 heard the story Amex is bankrupt because of the salad oil scandal, and sold in a panic, without ever checking the facts. The narrative investor in 1999 heard the story, the internet is the future, and bought Pets.com at any price, without ever checking the balance sheet. The process is identical, an emotionally driven reaction to a compelling story, completely divorced from a disciplined assessment of price versus value. The fatal flaw of narrative investing is that it has no margin of safety. When you buy a stock at a price that is not justified by its current or reasonably foreseeable earnings, you are counting on one thing and one thing only: that someone else, another narrative investor, will come along and buy it from you at an even higher price. This is the greater fool theory of investing. And it works, for a while. But eventually, narratives change, reality intrudes. A company that doesn't make money eventually runs out of money. When the story breaks, when the market realizes that eyeballs cannot be used to pay salaries or build warehouses, the collapse is swift and brutal. Because there was no underlying value to begin with, there is no floor for the stock price. It doesn't just correct, it evaporates. Investors who bought Pets.com for its story were left with nothing but worthless stock certificates. Investors who sold American Express for its story missed out on one of the great wealth creation opportunities of the decade. The path of the 99% is paved with compelling narratives. It's an easy, exciting path to walk, but it almost always leads off a financial cliff. The disciplined, value-oriented path is harder. It requires skepticism, independent thought, and the courage to ignore the crowd. But it is the only path that leads to consistent, long-term portfolio growth and true financial independence. The principle of margin of safety is not just an abstract philosophical concept, it has a direct, quantifiable, and massive impact on an investor's financial results. It manifests directly in your portfolio's performance, your wealth management strategy, and your ultimate capital gains. Let's break down exactly how this way of thinking translates into a tangible financial advantage. First and foremost, a margin of safety fundamentally alters the risk/reward profile of your investments. Most people believe that to get higher returns, you must take on higher risk. This is the traditional financial model. Value investing, through the margin of safety, turns this idea on its head. When you buy a stock for 50 cents that you conservatively calculate is worth $1, you are simultaneously lowering your risk and increasing your potential reward. Your downside risk is protected because even if your valuation is wrong by 10 or 20%, or if the company stumbles, the asset is still likely worth more than you paid. You have a built-in cushion against error and bad luck. At the same time, your upside potential is amplified. If the market eventually recognizes the true value of the business and the stock price moves from 50 cents to $1, you have achieved a 100% return. A traditional investor might buy that same stock at what they consider a fair price of 90 cents. Their upside is only about 11% from 90 cents to $1, while their downside risk is substantial. The margin of safety investor gets more upside with less downside. This is the holy grail of investing. Second, this principle directly impacts your portfolio's volatility and the quality of your returns. A portfolio built on businesses bought with a significant margin of safety will tend to be less volatile than the broader market. During market panics and recessions, these stocks often fall less than their overvalued counterparts because they already had a level of pessimism priced in. This lower volatility is not just comforting. It's a powerful psychological tool that helps prevent the biggest mistake an investor can make, selling at the bottom. It allows you to stick with your long-term investment strategy. Furthermore, it allows for more effective asset allocation. When you know your individual holdings have a built-in buffer, you can make more concentrated bets, following the CEO mindset of allocating capital to your highest conviction ideas, which is the fastest way to build real wealth. Third, the margin of safety has a profound effect on the most important financial metric for any long-term investor, the rate of compounding. By systematically purchasing assets at a discount, you are essentially front-loading your returns. This provides a higher base from which your capital can grow. Imagine two investors, both earning a 10% annual return on the underlying business they own. Investor A, a narrative chaser, pays full price. Investor B, a value investor, consistently buys at a 30% discount. Over time, Investor B's portfolio will grow exponentially faster, not just because of the business returns, but because of the additional return generated as the price closes the gap to value. This return from the discount acts as a powerful accelerant to the compounding engine, dramatically shortening the timeline to financial freedom. On a balance sheet, the margin of safety is like buying an asset for your personal net worth statement for far less than its appraised value. Every time you do it, you are instantly increasing your real, economic net worth, even if the market doesn't recognize it for months or years. It's the closest thing to a guaranteed profit in the entire field of finance, a promise you make to yourself at the moment of purchase, long before you ever think about selling. There is a character who lives inside the stock market. He is your business partner in every investment you will ever make. Some days, he shows up at your door euphoric, screaming about a golden future, and offers to buy your shares from you at ridiculously high prices. On other days, he appears inconsolable, weeping about economic ruin and imminent disaster, and offers to sell you his shares at prices so low they are practically a giveaway. This partner, of course, is Mr. Market. He is the brilliant allegorical creation of Benjamin Graham and the single most important mental model Warren Buffett has ever used to navigate the financial world. Understanding Mr. Market is not just an intellectual exercise. It is the key to unlocking the psychological discipline required to buy low and sell high. Your job as an investor is simple: to exploit his manic-depressive mood swings, not to be influenced by them. To truly understand how Buffett has mastered this relationship, we need to go back to the dark days of 1973. The American economy was in turmoil. The Nifty 50 stock market boom had just ended in tears, the Vietnam War was raging, the Watergate scandal was consuming the nation, and an oil crisis was strangling the economy, leading to a brutal combination of stagnant growth and high inflation known as stagflation. The mood on Wall Street was apocalyptic. Optimism was dead. It was a period of profound pessimism, and Mr. Market was in the depths of a crippling depression. In this environment of gloom, one of America's premier media enterprises, the Washington Post Company, was suffering alongside everything else. The Post was a phenomenal business. It owned the flagship newspaper, which had just broken the Watergate story and was at the peak of its journalistic power and influence. It also owned Newsweek magazine, several television stations in major markets, and other valuable media assets. It was a fortress of a business, with a deep competitive moat and tremendous long-term earning power. Yet, in the panic of the 1973-74 market crash, Investors wanted nothing to do with it. Mr. Market, in his despair, was convinced that the world was ending and that newspaper advertising revenue would evaporate forever. He was selling shares of the Washington Post Company with reckless abandon. The stock price, which had been trading at over $35 a share, collapsed. It fell below $30, then $20, then $10, eventually bottoming out around $6 per share. At that price, the entire company, the legendary newspaper, Newsweek, the highly profitable TV stations, was being valued by the market at a mere $80 million. Warren Buffett, watching from Omaha, saw a completely different picture. He wasn't listening to Mr. Market sobbing. He was coolly analyzing the business. He looked at the assets, the brand, the dominant market position of the television stations, and the immense, though intangible, value of the newspaper's reputation. He did a quick, conservative calculation and concluded that the intrinsic value of the business was, at a bare minimum, $400 million and likely closer to $500 million. Mr. Market, in a fit of depression, was offering to sell him dollar bills for 20 cents. This was not a time to be scared. This was a time to be greedy. Over the course of 1973, Buffett began buying shares of the Washington Post Company aggressively. He wasn't trying to time the bottom. He simply recognized that the price being offered was ludicrous compared to the underlying value. He invested nearly $11 million, acquiring a substantial stake in the company. The establishment was baffled. Investing in a newspaper during a recession seemed like madness. But Buffett wasn't investing in the stock market. He was buying a piece of an extraordinary business that his manic-depressive partner was desperate to unload. What happened next is history. The economy eventually recovered. The Post's earnings continued to grow. The market's mood swung, as it always does, from despair to optimism. Over the next decade, the value of Buffett's investment soared. That initial $11 million stake in the Washington Post would eventually become worth over $1 billion, representing one of the most successful investments of all time, a 100-fold return. This legendary investment was made possible by one thing: Buffett's absolute mastery of his relationship with Mr. Market. He saw his partner's depression not as a risk, but as a magnificent opportunity. He ignored the emotion and focused solely on the price being offered versus the value being received. It is the perfect illustration of his famous advice: be fearful when others are greedy, and greedy only when others are fearful. The parable of Mr. Market is so powerful because it perfectly captures two of the most potent and destructive cognitive biases that plague investors: herd behavior and the emotional pendulum of manic depression, or bipolarity. The market's wild swings are not a reflection of changing business fundamentals. They are a reflection of the collective psychology of its participants. And by understanding this, you can position yourself on the winning side of these behavioral flaws. Herd behavior, also known as social proof, is the deep-seated human instinct to follow the actions of a larger group. The underlying assumption is that if so many people are doing something, it must be the correct thing to do. In the wild, this is a survival mechanism. If you see everyone in your tribe suddenly run, you don't stop to ask why. You run, assuming there's a predator nearby. In the stock market, this instinct is a wealth destruction mechanism. When a stock is rising rapidly, it attracts attention. People see their neighbors getting rich. They read breathless headlines. They see the green arrows on their screen. The herd starts moving in one direction: buying. The rising price itself becomes the justification for buying. This is Mr. Market in his manic phase. The fear of missing out, FOMO, becomes overwhelming. People abandon their own analysis and simply trust the wisdom of the crowd, buying at higher and higher prices, convinced the trend will last forever. Conversely, when the market crashes, as it did in 1973, the herd stampedes in the opposite direction. The falling price becomes the justification for selling. Panic spreads. The fear of losing everything becomes the dominant emotion. People who swore they were long-term investors suddenly liquidate their portfolios at the point of maximum pessimism. This is Mr. Market in his depressive phase. They are letting the emotional state of the crowd dictate their financial decisions. The second principle is the market's inherent bipolarity. Mr. Market does not operate on a spectrum of calm, rational analysis. He swings violently between two extremes: irrational exuberance and unjustified despair. During the manic phase, he believes that profits will grow to the sky, that competition doesn't exist, and that every company is the next revolutionary force in the economy. He prices stocks for a perfect future that will never arrive. During the depressive phase, as in the case of the Washington Post, he believes that every problem is permanent, that recovery is impossible, and that good companies are doomed to fail. He prices stocks for an apocalypse that rarely materializes. The critical insight is that neither of these emotional states is an accurate reflection of reality. The true intrinsic value of a great business like the Washington Post doesn't change by 80% in a year. Its earning power, its competitive advantages, and its brand value are far more stable. What changes is the emotional lens through which Mr. Market is viewing that business. Warren Buffett's entire approach is built on exploiting this psychological flaw. He has cultivated the emotional discipline to act as a counter-cyclical force. When the herd is euphoric in buying, driven by greed, he is cautious or even selling. He understands that when Mr. Market is manic, the prices being offered are dangerously high, and the margin of safety is non-existent. When the herd is panicking and selling, driven by fear, as with the Washington Post, he becomes an aggressive buyer. He knows that his partner's depression is serving up wonderful businesses at bargain prices. He is essentially engaging in emotional arbitrage, profiting from the irrational mood swings of others. He treats Mr. Market not as a guide to be followed, but as a servant to be commanded. He is there to serve you with prices, not to provide you with wisdom. This psychological fortitude is arguably more important than any financial spreadsheet. The ability to buy when every instinct in your body and every person around you is screaming "sell" is the rarest and most valuable skill in all of investing. It is the only way to truly take advantage of the opportunities that Mr. Market's flawed personality will inevitably provide. To operationalize the wisdom of the Mr. Market parable, we need a practical system that allows us to exploit market emotions without being infected by them. We can create a mental model called the emotional arbitrage framework. This is a simple, rules-based approach to turn the market's psychological volatility into your greatest asset. Step 1 is to create your curated watch list of trophy assets. This isn't a list of 100 stocks. It's a small, manageable list of between 5 and 15 wonderful businesses that you have studied and genuinely understand. These are companies within your circle of competence. For each company on this list, you must be able to simply explain what it does, how it makes money, and why it has a durable competitive advantage. This is your personal hunting ground. Step 2 is to establish your valuation bookends. For each company on your list, you must perform a conservative calculation of its intrinsic value. This doesn't have to be a complex discounted cash flow model down to the penny. It can be a simple valuation based on a multiple of owners' earnings, or a reasonable price-to-earnings ratio based on historical norms. The goal is to arrive at a single conservative number that represents what you believe the entire business is worth today. Let's say for Company X, you calculate a fair intrinsic value of $100 per share. This number is your anchor of reality. It is the lighthouse that will guide you when the storms of market emotion hit. Step 3 is to set your emotional tripwires. Based on your intrinsic value calculation, you will now set 2 specific price alerts in your brokerage account or on a financial website. The first is the panic price. This is the price at which you will begin buying. A good rule of thumb is to set this at a 40% to 50% discount to your calculated intrinsic value. So for Company X, your panic price might be $50 or $60. The second alert is the euphoria price. This is a price so high it reflects pure market mania. You might set this at a 50% to 100% premium to intrinsic value. For Company X, this could be $150 or $200. This is the price at which you would consider trimming your position, or at the very least, stop buying completely. Step 4 is the most important and the most difficult. You do nothing. You go about your life. You ignore the day-to-day chatter, the analyst upgrades and downgrades, the market in turmoil headlines. You have outsourced your decision-making to your pre-calculated tripwires. You are not a servant to the market's daily noise. You are a patient predator waiting for the perfect moment to strike. Step 5 is execution with discipline. When one of your alerts is triggered, you act. If the panic price for Company X is hit because of some market-wide crash or bad news specific to the company, you don't panic. You don't second-guess your work. The alert is not a signal to reevaluate your thesis in a state of fear. It is a pre-authorized command from your past, rational self to your present self to start buying. Conversely, if the euphoria price is hit, that is your signal from your past self to resist the temptation of greed and the fear of missing out, and to consider taking some profits off the table. This framework systematically removes emotion from the decision-making process. It forces you to be greedy when others are fearful, and fearful when others are greedy, because your actions are tied to predetermined price levels, not to your feelings in the moment. You are treating Mr. Market exactly as Buffett does, as a bipolar partner who periodically offers you absurd deals, and your only job is to be ready and willing to transact when he does. This is how you transform market volatility from a source of anxiety into the primary source of your long-term returns. The path of the 99% is to become a willing servant to Mr. Market, a puppet whose strings are pulled by the twin emotions of fear and greed. This investor doesn't have a strategy, they have a collection of reactions. They don't see Mr. Market as a flawed business partner to be exploited, but as an all-knowing oracle to be obeyed. Their financial journey is one of constant whiplash, buying high and selling low, and wondering why they can never seem to make progress toward their goal of financial freedom. The servant of Mr. Market begins their day by checking the market futures. Their mood is set by whether the numbers are green or red. When the market is soaring, as it was in the final stages of the tech bubble, they feel brilliant. They are swept up in the euphoria. Their friends are talking about their stock market winnings. Financial news channels are celebrating new market highs, and the feeling of missing out is unbearable. So they buy. They buy the hottest stocks, the ones with the most exciting stories, at the highest valuations. They are buying directly from a manic Mr. Market, who is happily selling them shares at prices completely disconnected from reality. They feel smart and safe because they are doing what everyone else is doing. They are part of the herd. Then, inevitably, the market turns. A crisis hits, a recession looms, and the mood shifts from mania to depression. Mr. Market is now at their door every morning, wailing about bankruptcies and economic collapse. The servant investor's portfolio, filled with the high-flying stocks they bought at the peak, is bleeding red. The same news channels that celebrated the bull market are now broadcasting specials titled "Crisis on Wall Street." Their friends are no longer talking about their gains, they're whispering about their devastating losses. The pain of loss aversion kicks in. Every downtick feels like a physical blow. The fear becomes all-consuming. They can't take it anymore, they sell. They sell everything, often near the very bottom of the crash, just to make the pain stop. They are selling their shares to a depressed Mr. Market at bargain basement prices. In this destructive cycle, the servant investor has perfectly executed the strategy of buying high and selling low. They have allowed Mr. Market's mood swings to directly transfer wealth from their pocket into the pockets of disciplined investors like Warren Buffett, who are standing on the other side of those trades. Buffett was buying the Washington Post from these panicked sellers in 1974. He was buying Coca-Cola from them after the crash of 1987. He was buying American Express from them during the salad oil scandal. The servant's portfolio never has a chance to benefit from long-term compounding because it is constantly being uprooted by emotional decisions. They blame their losses on the market, on bad luck, or on a rigged system. They never realize that the enemy was not the market, but their own reflection in the mirror. They failed because they let an emotionally unstable business partner make all of their decisions for them. Breaking free from this servitude is the first and most critical step in any successful investment strategy. It requires the conscious decision to fire Mr. Market as your advisor and rehire him as a simple, occasionally useful but often irrational order taker. The mastery of one's relationship with Mr. Market is not just a psychological victory, it is a direct and powerful driver of financial performance. It is the engine that allows an investor to systematically lower their cost basis and magnify their capital gains over the long term. Let's trace the precise financial connection. The core advantage comes from exploiting volatility. Most investors view stock market volatility as risk. They fear it. The disciplined investor who understands Mr. Market views volatility as opportunity. It is the very mechanism that creates the price discounts they seek. When you consistently buy assets during periods of market pessimism and fear, you are systematically lowering the weighted average cost basis of your entire portfolio. Imagine you want to invest $1,000 in a great company over the course of a year. The average investor might just put all $1,000 in at once. Or they might dollar-cost average, investing $250 every quarter, regardless of the price. The Buffett-style investor, however, waits. They might invest their first $250 when the stock pulls back 10%. They invest the next $250 when a market panic causes it to drop 30%. They deploy the final $500 when some terrible news sends the stock plunging 50%. At the end of the year, all three investors own the same company, but the Buffett-style investor will have a dramatically lower cost basis. This has a massive impact on the back end of the investment: capital gains. The profit you make on an investment is the difference between your sale price and your cost basis. By intentionally lowering that cost basis, you are preloading a larger potential profit into every share you buy. When the market sentiment inevitably swings back from fear to greed and the stock price recovers to its intrinsic value, the investor who bought in the depths of pessimism will realize a much larger capital gain than the one who bought when the skies were clear. This directly translates to faster portfolio growth and a quicker path to building wealth. Furthermore, this approach creates a form of asymmetric return profile. By buying during panics, you are purchasing at a point where much of the bad news and potential risk is already priced into the stock. The downside from that point is often limited, as the worst-case scenarios are already the market consensus. The upside, however, is significant, as any piece of good news or simply a return to normalcy can cause the price to rebound sharply. You are taking on less risk to capture more reward. This is the financial manifestation of being greedy when others are fearful. On a more practical wealth management level, this strategy also dictates a crucial element of asset allocation: the need for cash. An investor who plans to exploit Mr. Market's mood swings must always have dry powder, a reserve of cash ready to be deployed when opportunities appear. Cash is a drag on returns during a bull market, and the servant of Mr. Market hates holding it. But for the disciplined investor, cash is not a dead asset. It is a strategic asset. It represents call options on future bargains, with no expiration date. Having cash on hand during a market crash is the financial equivalent of being the only person with an umbrella in a downpour. It is what allows you to turn the market's greatest moments of fear into your portfolio's greatest moments of growth. Ultimately, understanding Mr. Market is about shifting your entire frame of reference. The daily price quote is not a measure of a company's value. It is simply the price at which your emotionally unstable partner is offering to buy or sell today. By divorcing the concept of price from the concept of value, you liberate yourself from the market's psychological tyranny and transform yourself from a price taker into a price maker, patiently waiting to seize the incredible bargains that fear and panic will always, inevitably, leave in their wake. In the fast-paced world of investing, where screens flash with constant activity and the pressure to do something is immense, the most underrated and yet most powerful weapon an investor can possess is the simple act of doing nothing. It is the discipline of patience. Warren Buffett's career is not defined by frantic trading or chasing daily trends. It is defined by decades of patient observation, punctuated by brief, decisive moments of intense action when the perfect opportunity presents itself. The ability to wait, to sit on cash for years if necessary, until the price is right, is a cornerstone of the principle that you make your money when you buy. No story better illustrates this profound power of patience than Buffett's long courtship and eventual massive investment in the Coca-Cola Company. Buffett's admiration for Coke was not a secret. It was a love affair that began in his childhood. He started drinking it at age 6 and has famously consumed at least 5 cans a day for most of his life. As an investor, he saw far more than just a refreshing beverage. He saw a business masterpiece. He saw a product that was cheap, universally desired, and created a share of mind in customers globally. He saw a distribution system that was a work of art, placing Coke within an arm's reach of desire in virtually every country on Earth. He understood its simple, powerful economics: sell a concentrate for pennies that gets turned into a dollar product, and take a small piece of every transaction. It was, in his words, the perfect business. For decades, from the 1960s through the 1970s and most of the 1980s, Buffett watched Coca-Cola. He studied it, he admired it, he understood it better than perhaps any other company in the world. But he never bought a single share for his new vehicle, Berkshire Hathaway. Why? The price was never right. Throughout these years, Mr. Market was in love with Coke too. It was a blue-chip staple, a darling of Wall Street, and its stock price consistently reflected that optimism. The price was always at or above what Buffett considered its intrinsic value. There was no margin of safety. A lesser investor, infatuated with such a wonderful business, would have found a way to justify paying up. They would have told themselves, for a company this great, you have to pay a premium. But Buffett was disciplined. He knew that even the best business in the world can be a bad investment if you overpay. So he waited. And waited. For over 20 years he patiently sat on the sidelines, holding cash, watching his favorite company trade at prices he refused to pay. Then came October 19, 1987, Black Monday. The stock market experienced its largest single-day percentage drop in history. The Dow Jones Industrial Average plunged over 22%. Panic gripped the globe. The crash wasn't caused by any single piece of news about the economy, which was actually quite strong. It was a technical, liquidity-driven event amplified by new computerized trading programs. But the reason didn't matter to the panicked herd. Fear was in the driver's seat. In the weeks and months that followed, while most investors were nursing their wounds and terrified to re-enter the market, Buffett saw his moment. Mr. Market, who had loved Coca-Cola for decades, was suddenly terrified. He was now willing to sell shares of this unassailable global franchise at a significant discount. The market was worried about a potential recession and the impact of a weaker dollar on Coke's international earnings. Buffett saw this as short-term noise. He knew that a market crash didn't change the fact that billions of people around the world would still be thirsty tomorrow. The company's long-term earning power was completely unaffected. Between 1988 and 1989, Buffett acted with stunning speed and conviction. Berkshire Hathaway invested over $1 billion to acquire a massive stake in Coca-Cola, eventually owning about 7% of the entire company. After more than 2 decades of patient waiting, he had finally been offered the fat pitch he was looking for. He didn't just take a small swing, he swung for the fences. This investment became one of the cornerstones of Berkshire Hathaway's success. Within 10 years, that $1 billion investment was worth over $13 billion. It was a testament to the idea that patience is not passive, it is a strategic, offensive weapon. It allows you to conserve your capital and your mental energy, waiting for that rare moment when a great business is combined with a foolish price. The Coca-Cola story is the ultimate proof that in investing, you are not paid for activity, you are paid for your patience and your decisiveness. The human brain is fundamentally wired against the kind of patience Buffett demonstrated with Coca-Cola. 2 powerful psychological forces conspire to make us act when we should be waiting: the action bias and the craving for instant gratification. Overcoming these deep-seated urges is a prerequisite for any serious long-term investor. The action bias is our innate tendency to favor action over inaction, even when there is no rational evidence that doing something will lead to a better outcome. In many areas of life, this is a positive trait. A bias for action makes for a great entrepreneur or a successful salesperson. In the world of investing, however, it is a catastrophic flaw. The financial industry is built to exploit this bias. Your brokerage account is designed with flashing lights and real-time quotes to make you feel like you should be constantly trading. Financial news networks provide 24/7 commentary, creating a sense of urgency and the illusion that you must react to every piece of news. The very act of buying or selling feels productive. It feels like you are managing your money, taking control of your financial destiny. In reality, for the long-term investor, most of this activity is counterproductive. It's like a gardener who keeps pulling up their carrots to see if they're growing. The constant tinkering, the endless rebalancing, the chasing of the latest hot trend, it all serves to disrupt the one force that truly builds wealth, the power of compounding. Buffett's ability to sit still for 20 years while watching Coca-Cola is a superhuman feat of resisting the action bias. He understood that his job was not to be an active trader, but a capital allocator. And if the best allocation of capital at a given moment is to let it sit in cash, waiting for a better opportunity, then that is the most productive action he can take. The second related principle is our brain's desire for instant gratification. We are wired by evolution to prefer a small reward now over a larger reward in the future. Our ancestors needed to eat today. Planning for next year's harvest was a luxury. This ancient wiring is a disaster for our financial health. Investing is the ultimate delayed gratification game. You are planting a sapling today with the hope that it will grow into a mighty tree in 20 years. The modern world, with its on-demand services and instant social media feedback, has trained our brains to expect immediate results. We buy a stock and expect it to go up tomorrow. If it doesn't, we get anxious, bored, and look for something more exciting. We sell a great business that is temporarily stagnant to buy a speculative story stock that has doubled in the past month, seeking that quick dopamine hit of a fast gain. Buffett's patience is a direct rebellion against this desire for instant gratification. He is perfectly comfortable planting a seed and waiting decades for it to bear fruit. His time horizon is not next quarter or next year. It's forever. This long-term perspective allows him to ignore the short-term noise and focus only on the two things that matter: the quality of the business and the price he pays for it. By understanding these two biases, we can begin to counteract them. We can recognize that the urge to do something with our portfolio is often just our primitive brain seeking a sense of control or a quick thrill. We can consciously choose to embrace boredom, to see a portfolio that doesn't change for a year not as a sign of neglect, but as a sign of discipline. Patience is the shield that protects us from our own worst instincts, allowing the magic of compounding to work its slow but unstoppable will. To cultivate this superpower of patience, we need more than just willpower. We need a concrete mental model that forces us into a state of extreme selectivity. Warren Buffett provided the perfect tool for this when he told a group of business students to imagine that upon graduation, they would be given a punch card with only 20 slots on it. Every time they make an investment decision in their entire life, they have to punch one of those slots. Once the 20 punches are used up, they can't make any more investments. This 20-slot punch card rule is a brilliant blueprint for enforcing discipline and patience. Let's break down how to apply it. The first step is to internalize the philosophy of scarcity. You must truly accept that great investment ideas are exceptionally rare. The world is not filled with hundreds of brilliant, underpriced opportunities. In a typical year, you will be lucky to find one or two. In some years, you may find none. By thinking of your investment decisions as a scarce, non-renewable resource, your 20 punches, you immediately raise the bar for what qualifies as a worthy idea. This mindset shift is the antidote to the action bias. The second step is to create a formal punch-a-slot checklist. Before you are allowed to buy any security, you must run it through a rigorous written checklist. This checklist should ask critical questions. For example, is this business within my circle of competence, and can I explain it to a 10-year-old? Does it have a durable competitive advantage or moat? Is the management team both talented and honest? Is it currently being offered by Mr. Market at a significant discount to my conservative estimate of its intrinsic value? And finally, the most important question: is this opportunity so good, so clear, and so compelling that I am willing to use one of my 20 lifetime punches on it? This final question is the ultimate filter. It forces you to distinguish between a pretty good idea and a truly fat pitch. Most ideas will not pass this test. The simple act of asking this question will prevent you from making dozens of mediocre, low-conviction investments over your lifetime. It will stop you from buying a stock just because it's in the news or because a friend recommended it. The third step is to change how you measure success. Most investors measure success by the level of activity in their portfolio. The punch card model forces you to measure success by the quality and results of your very few decisions. An investor who makes only 10 investments in their life, with 7 of them being big winners, will vastly outperform an investor who makes 500 trades with mixed results. Your goal is not to be busy. Your goal is to be right, and to be right in a big way when you do act. Applying the 20-slot punch card rule transforms your entire approach to personal finance and wealth management. It forces you to do the deep research required to have high conviction. It forces you to wait patiently, sometimes for years, for the truly exceptional opportunity. It shifts your mindset from that of a stock renter or a speculator to that of a true business owner, carefully and deliberately allocating your precious capital to only the most deserving enterprises. It is the ultimate framework for turning patience from a passive virtue into an active, wealth-building strategy. The antithesis of the patient, selective investor is the hyperactive trader. This is the path of the 99%, an approach fueled by the illusion that activity equals progress. The hyperactive trader's life is a whirlwind of constant motion, but it's a motion that, more often than not, leads to financial ruin. Their journey is a cautionary tale of how the very tools and information meant to empower investors can become instruments of their own destruction. The hyperactive trader wakes up and their first action before even getting out of bed is to check their stock portfolio on their phone. Their day is a series of screen-staring sessions. They have multiple tabs open on their computer. One for real-time stock quotes, one for a financial news feed, another for a stock-focused social media platform. They are drowning in information but starved of wisdom. Their decisions are not based on a deep analysis of a business's long-term prospects. They are based on fleeting data points. They buy a stock because a headline announces a, quote, surprise earnings beat. They sell a stock because a well-known analyst issues a downgrade. They jump into a speculative biotech company based on a rumor in an online forum about an upcoming drug trial. They are constantly reacting, never anticipating. They confuse the ticker symbol, a flashing electronic blip, with the actual business it represents. This constant activity comes at a tremendous, often hidden cost. First, there are the explicit transaction costs. Every time they buy or sell, they are paying a commission or a bid-ask spread. While these costs may seem small on an individual basis, over the course of hundreds or thousands of trades, they act as a constant, grinding friction on the portfolio, a death by 1,000 cuts. Second, and far more damaging, are the tax inefficiencies. By constantly trading in and out of positions held for less than a year, the hyperactive trader ensures that any gains they do manage to make are taxed as short-term capital gains, which are taxed at the same high rates as ordinary income. The patient, long-term investor, by contrast, holds their winners for years, allowing them to qualify for the much lower long-term capital gains tax rate. This tax difference alone can create a massive divergence in after-tax returns over time. The greatest cost, however, is psychological. The hyperactive trader lives in a state of perpetual anxiety. Their emotional state is directly tied to the random, daily fluctuations of the market. This emotional volatility inevitably leads to catastrophic mistakes. They will inevitably get caught up in a speculative bubble and buy at the top, and they will inevitably be scared out of their positions during a crash and sell at the bottom. They are playing a game that is almost impossible to win, a game where they are pitted against high-frequency trading algorithms and institutional investors with far more resources. They mistake the adrenaline rush of trading for the quiet satisfaction of investing. Warren Buffett's office famously does not have a stock ticker. He doesn't want to know the daily price of his businesses. He knows that being bombarded with that useless information would only appeal to his worst instincts and tempt him into the hyperactive trader's game. He knows that his edge comes not from faster information, but from a better temperament and a longer time horizon. The hyperactive trader is focused on the next 10 minutes. Buffett is focused on the next 10 years. That is the fundamental difference between speculation and investment, and it is the difference between guaranteed frustration and a proven path to building lasting wealth. The discipline of patience is not an abstract virtue, it is a direct and powerful driver of financial returns. Its impact can be seen clearly on your brokerage statements, your tax returns, and the ultimate growth curve of your net worth. It is a strategy that systematically optimizes for the two most powerful forces in finance: compounding and tax efficiency. Let's start with the most direct financial connection: the dramatic reduction of frictional costs. Every transaction in a portfolio, whether a buy or a sell, incurs costs. There are explicit costs like commissions and implicit costs like the bid-ask spread. For a hyperactive trader, these costs can easily eat up 1% to 2% of their portfolio value each year. While that may not sound like much, consider the impact over a 30-year investing lifetime. A portfolio that would have grown to $1 million without these costs might only grow to $600,000 or $700,000 with them. Patience, by definition, leads to infrequent trading. A patient investor might only make 1 or 2 transactions a year, or even go years without making a single trade. Their frictional costs are functionally zero, allowing their entire capital base to remain invested and working for them. The second, and even more significant financial advantage, is tax optimization. This is a crucial concept for effective wealth management. In the United States, investment gains are taxed very differently based on how long you hold the asset. If you hold a stock for 1 year or less and sell it for a profit, that profit is considered a short-term capital gain and is taxed at your marginal income tax rate, which can be as high as 37%. If you hold that same stock for more than 1 year, the profit is a long-term capital gain, and it is taxed at preferential rates, typically 0%, 15%, or 20%, depending on your income. This is a massive difference. A patient buy-and-hold investor is effectively giving themselves an automatic 15 to 20% boost on their returns compared to an equally skilled short-term trader, purely because of tax efficiency. This is a structural advantage that Buffett has exploited his entire career. He aims to buy businesses and hold them forever, allowing them to grow tax-deferred within the structure of Berkshire Hathaway. The third and most powerful financial connection is the unleashing of uninterrupted compounding. Compounding is the process where your investment returns themselves begin to generate their own returns. Albert Einstein supposedly called it the 8th wonder of the world. For compounding to work its magic, it needs 2 things: a decent rate of return and a long, uninterrupted runway of time. Every time a hyperactive trader sells a position, they are resetting the clock on compounding. They take their principal and their gain, pay a hefty chunk of it to the government in taxes, and then have to start over with a smaller capital base. The patient investor leaves their capital invested. The gains from year 1 become part of the principal for year 2. The combined gains from years 1 and 2 become part of the principal for year 3. Over decades, this process creates an exponential J-curve of wealth growth that is impossible to achieve with a short-term trading strategy. Patience is the guardian of the compounding process. It is the discipline that allows time to become your greatest ally rather than your enemy, transforming modest savings into a substantial fortune and paving a clear, reliable path toward true financial independence. At the heart of Warren Buffett's entire philosophy is a simple quest: to determine what a business is worth and then to pay a lot less for it. This requires moving beyond the flashing ticker symbols and the ever-changing stock prices to grasp a more profound and enduring concept: intrinsic value. This is the true underlying value of an asset, based on the cash it can generate over its lifetime. Calculating this value, even imprecisely, is the critical step that separates investing from speculation. It is the act of creating your own private yardstick of worth, allowing you to ignore the public scoreboard of the market. A pivotal moment in Buffett's education on this topic, a story that fundamentally shifted his approach from a purely quantitative one to a more holistic view of value, was the acquisition of See's Candies in 1972. At the time, Buffett and his partner Charlie Munger were still operating primarily under the cigar-butt school of investing they had learned from Ben Graham. This meant looking for statistically cheap companies, often mediocre businesses trading for less than their liquidation value. See's Candies was different. It wasn't a statistical bargain in the traditional sense. See's was a high-quality, family-owned boxed chocolate company based in California, with a fiercely loyal customer base and a powerful brand. The company was being offered to Berkshire Hathaway for $30 million. The owners, the See family, were firm on their price. Buffett and Munger analyzed the financials. The company had about $8 million in tangible assets, things like factories and inventory. The asking price of $30 million was nearly 4 times the book value. For the old, Graham-style Buffett, this was a non-starter. He was used to buying businesses for less than the value of their tangible assets alone. Paying a $22 million premium for goodwill or brand value seemed extravagant. His initial calculation told him the price was too high, and he was ready to walk away from the deal. This is where Charlie Munger's influence became transformative. Munger pushed Buffett to think differently. He argued that the true value of See's Candies was not in its tangible assets, but in its intangible ones. The real asset was the brand's power in the minds of its customers. This power gave See's a durable competitive advantage: pricing power. Because customers loved the brand and associated it with quality and nostalgia, See's could raise its prices year after year to cover inflation and increase profits, without losing business to cheaper competitors. This intangible moat was an enormous economic asset. Even though it didn't appear on the balance sheet, Munger convinced Buffett that it was better to pay a fair price for a wonderful business that could grow its earning power over time than to get a wonderful price for a fair business that was always struggling. They reevaluated their definition of intrinsic value, incorporating the qualitative aspects of the business. They concluded that the future cash flows generated by See's powerful brand would more than justify the $25 million they ultimately paid for the company. They negotiated it down slightly. The acquisition of See's Candies was a watershed moment. It taught Buffett and Munger that intrinsic value is not just about what a company owns, it's about what it can earn. Since 1972, that little candy company, purchased for $25 million, has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, and it did so without requiring significant additional capital investment. It became the prototype for the kind of business Buffett would seek for the rest of his career: companies with strong brands, simple economics, and durable competitive moats. The See's Candies story is the perfect lesson in understanding that the price you are willing to pay must be based on a forward-looking assessment of a business's earning power, not a backward-looking accounting of its assets. It is the crucial leap from being a mere stock picker to becoming a true business analyst. The near failure to purchase See's Candies reveals a powerful psychological trap that even sophisticated investors fall into: the anchoring bias, combined with a tangibility bias. These cognitive shortcuts can blind us to the true value of a business and cause us to miss out on incredible opportunities. Understanding them is key to developing a more nuanced and effective valuation mindset. The anchoring bias is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In the See's Candies deal, Buffett's initial anchor was the company's book value of $8 million. His entire analysis was then framed relative to that number. The $30 million asking price seemed outrageous in comparison to that anchor. This bias is prevalent in the stock market. An investor might see that a stock was trading at $100 a year ago and is now at $50. They anchor to the $100 price and conclude the stock must be cheap, without doing any analysis of whether the business's fundamentals have deteriorated. Conversely, a stock at an all-time high might seem expensive simply because it is far from any previous anchor points, even if its earnings have grown to justify the new price. Buffett's initial reluctance was a classic case of anchoring to a quantitative metric he was comfortable with, tangible book value, and letting it disproportionately influence his judgment. The second related bias at play is the tangibility bias. Our brains have a preference for dealing with things that are concrete, physical, and easy to count. We instinctively assign more importance to a factory or a pile of inventory than we do to an abstract concept like brand equity or customer loyalty. We can see and touch the factory. We can't see or touch the brand. Because intangible assets are harder to quantify, we tend to systematically undervalue them in our analysis. Buffett, trained by Graham, was initially focused on the $8 million in tangible assets. He struggled to assign a concrete value to the $22 million premium for C's reputation. Charlie Munger's genius was in forcing him to overcome this bias. Munger understood that in modern capitalism, the most valuable assets are often intangible. The Coca-Cola brand, the Google search algorithm, the network effect of American Express. These are the sources of immense, durable profits, and they are worth far more than any factory or office building. The evolution in Buffett's thinking was to learn how to see these intangible assets and appreciate their profound economic impact. He learned that a powerful brand creates pricing power, which leads to higher margins. A strong reputation creates customer loyalty, which leads to recurring revenue and lower marketing costs. These are not fuzzy, feel-good concepts. They are powerful drivers of cash flow. An investor who is blinded by the tangibility bias will consistently overlook the best businesses of our time because their greatest assets don't show up neatly on a balance sheet. By overcoming these biases, Buffett was able to develop a more sophisticated and realistic approach to calculating intrinsic value. He learned that value is not about what a business has spent in the past, but what it can earn in the future. This forward-looking perspective, which fully embraces the economic power of intangible assets, is the only way to accurately assess the worth of a wonderful company and determine the right price to pay for it. Translating the theory of intrinsic value into a practical calculation is the core skill of a value investor. While the concept can seem intimidating, Warren Buffett's preferred method, which he calls provides a straightforward and powerful blueprint. It's a way of thinking about a company's profitability as if you were the sole owner of the business. Let's create a simplified framework for this owner's earnings valuation model. Step 1 is to calculate the owner's earnings. You start with the company's reported net income, which you can find on its income statement. This is the accounting profit, but we need to get closer to the real cash profit. So you add back any non-cash charges, primarily depreciation and amortization. These are accounting expenses, but no actual cash leaves the company for them. Then comes the crucial and most subjective part. You must subtract the average annual amount of capital expenditures, or CapEx, that the business needs to spend just to maintain its current competitive position and unit volume. This is called maintenance CapEx. You want to separate this from growth CapEx, which is money spent to expand the business. The formula is owner's earnings equals net income plus depreciation / amortization maintenance CapEx. This final number represents the true cash profit that the business generates in a year, the cash that a private owner could, in theory, pull out of the business without harming its long-term prospects. Step 2 is to project these earnings into the future. This is where you must be a conservative business analyst. Look at the company's past growth rate, the industry's prospects, and the strength of its competitive moat. Based on this, project the growth of the owner's earnings over the next 10 years. It is critical to be conservative here. If a company has been growing at 15% per year, you might project a growth rate of 7% or 10% to give yourself a margin of safety in your assumptions. Step 3 is to apply a terminal value. A great business doesn't just stop generating cash after 10 years. The terminal value is an estimate of what the business will be worth at the end of your projection period. A simple way to do this is to take the owner's earnings in year 10 and apply a conservative multiple to it, say 10x or 12x, which represents the price a private buyer might pay for the company. Step 4 is the discounting process. This is the principle that $1 in the future is worth less than $1 today. You need to take all of your projected cash flows, the 10 years of owner's earnings, plus the terminal value, and discount them back to their present-day value. The discount rate you use is a personal choice, but a common and conservative approach is to use the rate of a long-term U.S. Treasury bond. This represents your risk-free alternative. If you can't earn more than the government bond, the investment isn't worth the risk. The final number you get after adding up all the discounted cash flows is your estimate of the company's intrinsic value. This is your number. It's your private assessment of what the business is worth. The final step is to compare this intrinsic value per share to the current stock price. Your goal, as a value investor, is to buy only when the stock price is at a significant discount, 25%, 40%, even 50%, to your calculated intrinsic value. That discount is your margin of safety. It protects you if your growth projections were too optimistic or if the company hits a rough patch. This blueprint is not about finding a precise perfect number. Valuation is part science, part art. The goal is to be approximately right rather than precisely wrong. By going through this disciplined process, you force yourself to think like a business owner, to focus on long-term cash generation, and to build a rational, evidence-based case for the price you are willing to pay, freeing you forever from the emotional whims of Mr. Market. The path of the 99%, the antithesis to the disciplined calculation of intrinsic value, is a world of intellectual shortcuts and flawed comparisons. It's the world of relative valuation follies. Instead of asking, what is this business worth in absolute terms, the average investor asks, is this stock cheap or expensive compared to something else? This seemingly logical question is a trap that leads to disastrous investment decisions, especially during market bubbles. The most common form of relative valuation is the price-to-earnings, PE ratio. An investor will look at a company, see that it trades for 15 times its annual earnings, and compare that to the industry average of 20 times earnings. They conclude, this stock is cheap. The fatal flaw in this logic is that it provides no anchor to reality. It's like judging a person's weight by saying they are skinnier than the other people in this room, when the room happens to be filled with morbidly obese individuals. The entire industry might be wildly overvalued. Being cheaper than other overvalued assets does not make something a good investment. During the dot-com bubble, this folly reached its zenith. Tech companies with no earnings had no PE ratio, so Wall Street invented new relative metrics like price to sales, or even more absurdly, price to eyeballs. An analyst would justify the multi-billion-dollar valuation of a loss-making company by saying its price-to-sales ratio was lower than its competitors. They were comparing one ridiculously overvalued company to another, creating an echo chamber of speculative justification. They were all collectively floating off into space, having cut the tether of intrinsic value that once held them to Earth. Another common relative valuation folly is anchoring to a stock's past price. An investor sees a stock that has fallen from $200 to $100 and thinks it's 50% off, it must be a bargain. The past price is irrelevant. The only thing that matters is the current price relative to the present value of the company's future cash flows. The business may have fundamentally deteriorated, making it worth only $50. In that case, paying $100 is no bargain at all. It's a path to a further 50% loss. The intrinsic value investor, like Warren Buffett, operates from a foundation of absolute value. Their calculation of a business's worth is independent of its industry peers or its own past stock price. It is based solely on its ability to generate cash. This provides a stable, rational anchor in the midst of a chaotic and often irrational market. It allows them to say no to an entire industry or even the entire market if prices are too high. The relative value investor has no such anchor. They are swept along by the prevailing tides of market sentiment. In a bull market, everything looks reasonable compared to everything else, so they keep buying. In a bear market, everything looks scary, so they sell. They are destined to follow the herd because their very method of valuation is based on comparing themselves to the herd. This reliance on relative metrics is the lazy way out. It's easier to look up a P/E ratio than to build a discounted cash flow model. But as with all things in investing, the easy path is rarely the profitable one. True financial success requires the discipline to do the hard work of independent thought and to base your decisions not on the shifting sands of relative comparison, but on the solid rock of intrinsic value. The rigorous process of calculating intrinsic value is not an academic exercise. It is the most direct way to create a massive and sustainable financial advantage. It directly impacts your personal balance sheet, your portfolio's return on invested capital, and ultimately, your ability to achieve financial independence. Let's trace the financial connection. First, by calculating an absolute value for a business, you create an anchor for all your decision-making. This anchor has immense economic worth because it immunizes you from the market's emotional turmoil, which is the primary cause of wealth destruction. When the market is in a panic and the stock you own has fallen 30%, the relative investor panics with it. The intrinsic value investor, however, can look at their calculation and say, the price is now even further below my estimate of its true worth. This is not a crisis. It is an even better buying opportunity. This allows them to add to their positions at bargain prices, systematically driving down their cost basis and amplifying their future returns. Financially, this means your portfolio's return on equity will be significantly higher over the long term. You are not just buying good businesses. You are buying good businesses at prices that guarantee a high rate of return on your deployed capital from the very beginning. The purchase price locks in that potential. If you estimate a business is worth $100 and will grow at 8% a year, buying it for $50 means your expected return is not just the 8% business growth, but also the eventual closing of the price-to-value gap, which can more than double your effective rate of return in the early years of the investment. This has a profound impact on the compounding of your wealth. Second, this focus on intrinsic value, rooted in future cash flows, fundamentally changes what you look for in a business. It forces you to prioritize companies with high returns on invested capital, ROIC themselves. You begin to search for businesses like See's Candies, which can grow and generate massive amounts of cash without requiring huge continuous capital infusions. These are the true compounding machines. A portfolio filled with these types of businesses, bought at sensible prices, will naturally generate superior returns over time. It becomes a self-fueling engine of wealth creation, where the profits from your holdings can be reinvested into other similarly attractive opportunities. This directly improves the overall quality of your personal financial statement. You are not just acquiring paper assets. You are acquiring fractional ownership of highly productive, cash-gushing enterprises. This is the CEO mindset applied to personal finance. A CEO's job is to allocate the company's capital to projects with the highest expected return. Your job, as the CEO of Your Name Inc., is to do the same with your personal capital. The framework of intrinsic value is the tool that allows you to make rational, high-return allocation decisions. Ultimately, the practice of valuation is what elevates you from a passive participant in the market to an active, intelligent owner of businesses. It's the skill that allows you to confidently say yes when the price is right, and just as importantly, to say no to the thousands of overpriced distractions the market will throw at you. This discipline of price consciousness, grounded in your own independent calculation of worth, is the final and most crucial link in the chain that leads from saving to investing, and from investing to true and lasting financial freedom. The culmination of Warren Buffett's entire investment philosophy, mastering your emotions, patiently waiting for an opportunity, and calculating a business's true worth, all leads to a single powerful moment of action. This is the philosophy of the fat pitch, In baseball, a batter who swings at every pitch, no matter how wild, is destined to strike out. The legendary hitter Ted Williams famously divided the strike zone into 77 baseball-sized squares and knew he would only get a hit if he swung at pitches in his, quote, happy zone. He had the discipline to wait for the pitch he wanted. In investing, Buffett applies the same logic. You don't have to swing at every idea that comes along. There are no called strikes. You can wait and wait and wait for that one perfect, slow, easy-to-hit pitch right down the middle of the plate. And when that fat pitch finally arrives, you don't just take a little bunt, you swing with everything you've got. This principle of concentration, of betting big on your highest conviction ideas, is the final step in translating the price you pay into extraordinary portfolio growth. The most dramatic modern example of this philosophy in action is Berkshire Hathaway's massive, multi-billion-dollar investment in Apple, starting in 2016. For decades, Buffett famously avoided technology stocks. He often said they were outside his circle of competence, that their futures were too unpredictable. The market viewed Apple as the quintessential tech company, a volatile and innovative giant whose fortunes rose and fell with the release of the next iPhone. But by 2016, Buffett and his investment lieutenants, Todd Combs and Ted Weschler, began to see Apple differently. They saw that the market was mischaracterizing the business. They didn't see a speculative tech company. They saw one of the greatest consumer product companies in the history of the world. They saw the iPhone not as a piece of technology, but as an indispensable part of modern life, the central hub of a person's digital existence. The moat around Apple wasn't just its hardware. It was the powerful, sticky ecosystem of software and services, the App Store, iCloud, iMessage, that locked customers in and created incredible loyalty. At the time, Mr. Market was worried. The narrative on Wall Street was that the smartphone market was saturated and that Apple's incredible growth story was over. People were concerned about slowing iPhone sales in China. The stock was trading at a surprisingly low valuation, a P/E ratio that was cheaper than many slow-growing consumer staple companies. The market was offering a, quote, fat pitch. A business with arguably the strongest brand in the world, with hundreds of billions in cash and a fanatically loyal customer base, was being offered at a price that suggested it was just an average company with a cloudy future. Recognizing this massive disconnect between price and value, Berkshire didn't just nibble, they acted with immense conviction. Over the next few years, they began to buy Apple stock, and they didn't stop. They bought billions, then tens of billions of dollars worth. It was a concentrated, massive bet. By the time they were done, Apple had become by far the single largest stock holding in Berkshire Hathaway's portfolio, a position that would eventually grow to be worth well over $100 billion, generating staggering capital gains and billions in annual dividends. The Apple investment is the ultimate case study in the fat pitch philosophy. It required patience, waiting decades to enter tech, the courage to be a contrarian, buying when the market was worried about peak iPhone, a deep understanding of intrinsic value, seeing Apple as a consumer franchise, not a tech company, and finally, the conviction to concentrate a massive amount of capital when the price was right. This is how you move the needle. This is how you transform a portfolio from a simple savings vehicle into a true wealth creation engine. It's the final promise of price-conscious investing. When you find that rare opportunity where a wonderful business meets a foolish price, you must have the courage to act decisively. The tendency of most investors to do the exact opposite of betting big on their best ideas can be explained by two powerful psychological phenomena: the Dunning-Kruger effect and the resulting sin of diversification. Understanding these forces reveals why the average investor's portfolio is often a recipe for mediocrity. The Dunning-Kruger effect is a cognitive bias wherein people with low ability at a task overestimate their own ability. The less you know, the less you're able to recognize how little you know. In investing, this manifests as a dangerous overconfidence. A novice investor, after a few lucky trades in a bull market, starts to believe they are a stock-picking genius. They think they have a unique ability to predict the market and identify dozens of winning companies across a wide range of industries. They fail to appreciate the immense role that luck played in their initial success and the profound difficulty of consistently beating the market. This overconfidence leads directly to the practice of diversification, a term coined by legendary fund manager Peter Lynch. It's the process of diversifying your portfolio so broadly that it becomes a cluttered, unmanageable, and ultimately underperforming collection of assets. The investor afflicted by Dunning-Kruger believes they need to own 50 or 100 different stocks to be, quote, diversified. They buy a little bit of everything. A tech stock they heard about on TV, a pharmaceutical company their brother-in-law mentioned, a trendy alternative energy startup, a Chinese e-commerce giant. The resulting portfolio is not a carefully constructed machine for wealth creation. It's a financial junk drawer. There are two fatal flaws with this approach. First, it's impossible for any individual to adequately research and monitor 50 different companies. They end up not knowing much about anything they own. They don't understand the business models, the competitive advantages, or the valuation of their holdings. They are owners in name only. Second, diversification guarantees mediocrity. Even if one of their 100 stocks turns out to be a massive winner and goes up tenfold, its impact on the total portfolio is negligible because it was only a 1% position to begin with. Their best ideas are starved of capital, while their inevitable losers act as a constant drag on performance. This over-diversified portfolio ends up performing like an expensive self-managed index fund, but without the low costs and simplicity. Warren Buffett's philosophy of concentration is the perfect antidote to this trap. It is rooted in a profound sense of intellectual humility, the exact opposite of the Dunning-Kruger effect. Buffett freely admits that great investment ideas are incredibly rare. He knows that his area of expertise is limited. He doesn't try to be an expert in everything. Instead, he focuses all his energy on identifying a very small number of truly exceptional opportunities that he understands deeply. This humility is precisely what gives him the confidence to bet big when one of those rare opportunities appears. Because he has done the exhaustive work, because the business is squarely within his circle of competence, and because the price is overwhelmingly attractive, the decision becomes simple. He is not making 50 small, low-conviction guesses. He is making one or two large, high-conviction investments. He is choosing to be the master of a few things, rather than a dilettante of many, and that is the path to exceptional returns. To implement the fat pitch philosophy with discipline and avoid the trap of diversification, we need a practical blueprint. This mental model can be called the Circle of Competence Investment Mandate. It is a three-step process that combines intellectual humility with decisive action, ensuring that your capital is concentrated in your very best, most well-researched ideas. Step 1 is to define, in writing, your circle of competence. This is the most important act of intellectual honesty you will perform as an investor. Take out a piece of paper and write down the industries, business models, and technologies that you genuinely understand with a high degree of expertise. This understanding can't be superficial. It should come from your professional career, a deep personal passion, or years of dedicated study. For example, if you've been a software engineer for 20 years, enterprise software companies might be in your circle. If you've run a successful retail business, you might understand consumer brands and logistics. Be brutally honest with yourself. For most people, this will be a very short list. That is not a sign of weakness. It is a sign of wisdom. Step 2 is to create your too hard pile. Everything that is not on your written list from step 1 goes into this pile. This is your forbidden zone. A revolutionary biotech company with a promising but unproven drug? Too hard. A complex financial derivatives firm? Too hard. A cryptocurrency with a new blockchain protocol? Too hard. This step is about aggressively filtering out the vast majority of investment opportunities that the world will present to you. You are giving yourself permission to ignore them, no matter how exciting the story sounds or how much money your neighbor claims to be making. This protects your capital from your own ignorance and prevents the kind of speculative bets that lead to permanent loss. Step 3 is to apply the fat pitch filter and execute with courage. You now focus all of your analytical energy exclusively on the companies within your defined circle of competence. You study them, you follow them, and you wait. You are waiting for the rare intersection of three events: a wonderful business from your circle, a temporary problem or market panic that creates a foolish price, a massive discount to your calculated intrinsic value, and the availability of your own investment capital. When these three things align, you have found your fat pitch. This is the signal to act with conviction. Following this mandate, you should not allocate capital equally among your ideas. When a true fat pitch opportunity appears, you should allocate a significant portion of your investment capital to it. For a concentrated portfolio, this could mean putting 5%, 10%, or even 20% of your funds into a single high-conviction idea. This is the step that requires courage. It's easy to buy a 1% position. It takes true conviction, born from deep research and the discipline of this framework, to make a meaningful bet. This model transforms you from a collector of stocks into a professional capital allocator. It ensures that your limited time and brainpower are focused only on the opportunities you are most qualified to assess. It forces patience, as fat pitches are rare, and it demands courage when they finally appear. This is the systematic process for building a portfolio that doesn't just grow, but has the potential to generate true, life-changing wealth. The path of the 99% leads to a portfolio that can best be described as the collector's approach. This investor treats stocks like trading cards or souvenirs. Their portfolio is not a coherent, strategic collection of assets designed to achieve a financial goal. It is a random, disorganized scrapbook of past hunches, hot tips, and fleeting interests. The collector's portfolio is a reflection of a mind that lacks conviction and a strategy that lacks discipline. You can see their entire investment history just by looking at their holdings. There's that one share of a hyped IPO they bought out of fear of missing out. Over there is a handful of shares in a cannabis company that was all over the news 3 years ago. Next to it is a small position in an obscure mining stock that a friend at a barbecue swore was the next big thing. Their portfolio has dozens, sometimes hundreds, of these small forgotten positions. They own so many different things that they have effectively lost track. They couldn't tell you what half of these companies actually do, let alone whether they are attractively priced. The collector's primary mistake is confusing diversification with collecting. True diversification is about holding a few, carefully selected, non-correlated assets to reduce risk. The collector's diversification is about owning a tiny piece of everything in the hope that something, anything, will strike it big. They are playing a game of chance, not a game of skill. This approach is financially ruinous for several reasons. First, as we've discussed, it guarantees mediocre returns. The winners are too small to make a difference, and the losers are a constant drag. Second, it's an administrative nightmare. Keeping track of dozens of positions, dividend payments, and tax documents is enormously complex and time-consuming. Third, and most importantly, it reveals a complete lack of a core investment philosophy. The collector has no fat pitch philosophy because they have no way of identifying what a good pitch even looks like. Every idea is treated with the same weight, a tiny, non-committal allocation of capital. They lack the courage of their convictions because, in truth, they have no real convictions. Warren Buffett has said that diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. The collector's portfolio is the ultimate admission of ignorance. It is a tacit acknowledgement that they don't know how to distinguish a great investment from a poor one, so they simply buy a little bit of them all. The alternative, the path of the focused, concentrated investor, is a declaration of confidence. It is a statement that says, "I have done the work, I understand this business, I have waited for the right price, and I am willing to bet meaningfully on my own judgment." One path leads to a cluttered portfolio and average results at best. The other leads to a clean, simple, and powerful portfolio with the potential for extraordinary, market-beating growth. The fat pitch philosophy of concentrating your capital into your best ideas is the final, decisive link between a sound investment strategy and the actual, tangible creation of massive wealth. Its connection to your financial bottom line is the most direct and powerful of all the principles we have discussed. It is about simple, brutal mathematics. Let's consider two investors, both with $100,000 to invest. Investor A is the collector. They diversify broadly, putting 1% of their capital, or $1,000, into 100 different stocks. Investor B is the concentrator. They follow the circle of competence mandate, and after a long period of patience, identify one single fat pitch opportunity. They invest 10% of their capital, or $10,000, into this one idea. Now, let's assume both investors are skilled, and their chosen stock turns out to be a huge winner, doubling in value over the next few years. For investor A, their $1,000 position becomes $2,000. It's a $1,000 gain. This represents a mere 1% increase in their total portfolio value. Their brilliant insight had virtually no impact on their net worth. For investor B, their $10,000 position becomes $20,000. It's a $10,000 gain. This represents a full 10% increase in their total portfolio value. The exact same investment insight produced 10 times the financial result. Now, imagine this process repeated over an entire investment lifetime. The concentrator, by making only a handful of large, successful bets, will see their net worth grow at an exponential rate. The collector, even if they have the same number of winning ideas, will see their portfolio plod along, its growth muted by the dead weight of their other 99 mediocre holdings. This is how you achieve truly transformative portfolio growth. It is not by getting 1,000 small things right. It is by getting a few critically important things right and betting accordingly. This principle of concentration is the ultimate driver of market-beating returns. An index fund, by definition, is the ultimate collector, owning a tiny piece of hundreds or thousands of companies. That is why it can only ever produce the market's average return. To beat the market, you must deviate from the market. You must build a portfolio that looks different, and the most effective way to do that is to concentrate your capital in your best, most undervalued ideas. On your personal financial statement, concentration is what turns your investment portfolio from a passive savings account into an active engine of capital appreciation. It means that the capital gains line item on your financial reports will be driven by a few significant, meaningful winners rather than a mishmash of tiny ups and downs. This is the mindset of an entrepreneur or a CEO. A successful entrepreneur doesn't start 10 different mediocre businesses. They pour all of their time, money, and energy into one great idea. As an investor, your capital is your energy, and the fat pitch philosophy is the discipline that ensures you are focusing it where it can have the greatest possible impact, creating the most direct and rapid path to achieving your goal of profound and lasting financial independence. You have just spent this time fundamentally re-engineering the very core of your investment philosophy. You have moved beyond the noise and the speculation, and you have acquired a powerful mental tool, a complete system of thought modeled on the most successful investor in history. You now understand that the game is not won by predicting the future or by knowing when to sell. The game is won at the point of purchase. You have learned that a margin of safety is not just a theory, but a tangible fortress you build around your capital. You have been introduced to Mr. Market and now know how to transform his emotional instability from a terrifying threat into your single greatest source of opportunity. You have internalized the immense power of patience and the discipline of the 20-slot punch card. You have a framework for calculating a business's true intrinsic value, and you understand the wisdom of waiting for that one fat pitch and swinging with conviction. This is not just information. This is a weapon. It is the blueprint for shifting the odds of financial success permanently in your favor. But what you have just mastered, as powerful as it is a single crucial pillar in a much larger architecture. Warren Buffett's system of success is not a linear checklist. It is a network of interconnected mental models that support and reinforce one another. Knowing the price you should pay is the foundation, but it is not the entire structure. The question that remains, the piece of the map you are still missing, is what to do once you have paid that price. How do you identify the truly magnificent businesses, the ones with unbreachable moats that are worthy of your patient capital in the first place? How do you assess the managers running these companies to ensure they are the kind of partners who will build, not destroy, your wealth? The video that YouTube has chosen for you next is not an accident. It is the logical next step in your journey. Think of it as the missing link, the piece that connects the what price to pay with the what business to buy. It is the next layer of the mental arsenal you are building. The choice you have right now is not simply whether to watch another video. It is a choice about your identity. Are you a passive spectator content with a single piece of the puzzle? Or are you a serious architect of your own financial future, committed to acquiring the complete set of tools? The dabblers will stop here. The builders, the future CEOs of their own lives, will continue the ascent. If you are ready to master the next principle and connect what you have learned today to the broader framework of lasting wealth, then your path is clear. Complete your arsenal. Click and continue the journey.